The Panic of 1873 was the first global financial crisis. In Europe and North America, stocks tanked, banks collapsed, and economic recessions or depressions followed. Unlike any other crisis before, the Panic of 1873 happened as economic interconnectedness was visible and intense. It was the first financial crisis after the transatlantic cable, in a period of world trade explosion. What can we learn from this to avoid a similar fate as investors? Let's start with the setting. Historian Hannah Davies notes that the late 1860s were a period of economic boom in Europe and America. From 1830 to 1870, world trade grew 53% per decade as tariff barriers fell. In Germany, reforms spurred the flow of goods and people, and new 1870 laws meant that promoters no longer needed licenses to launch joint stock companies, which mushroomed. French war indemnities were channeled through London, the world's financial hub, to stock markets in Germany and Austria. Capital markets boomed. Across the pond in the US, the Civil War ended, and economic growth followed. As in Germany, the railway network expanded rapidly in the US and stimulated other sectors, notably mining and iron. The scale and scope of these new enterprises compelled promoters to raise capital in public capital markets, selling stocks and bonds widely. The London financial hub was central to this prosperity, as many Europeans invested in US railroads. But clouds gathered in the horizon. Hannah Davies notes that German observers had already coined the term world economy to denote something new, nations with different roles in one global economy. But as ads for new stocks and bonds proliferated in newspapers on both sides of the Atlantic, observers wondered how far this boom could run. Commentators had noted that financial panics were a recurrent topic. What if a panic like the one last seen in 1857 were to erupt? By the 1870s, the world was more interconnected than ever. Hannah Davies continues. In 1872, the German demand for American railroad bonds declined precipitously. In the previous year, 3 American railroads had defaulted on their payments, and by 1872, that number would climb to a total of 12. One observer then noted that the German market for American railway bonds or securities of any kind had practically ceased to exist. But the sudden European distaste for American railroad bonds elicited little alarm among financial writers. Historian Nicolas Barrère explains another crack in the facade: the seasonality of the New York financial market. Many country banks deposited reserves in New York banks, and recalled them every fall to move crops harvested in the Midwest. This drained money from New York, in a dangerous situation that had alarmed bankers for a long time. Yet another crack in the facade is shown by Christoph Nitschke, who describes how European trust in U.S. railroads eroded. In the late 1800s, much of the U.S. rail investments was financed by European investors. But in 1872, fraud and corruption was revealed around Crédit Mobilier, the financial company behind the Union Pacific Railroad, that liberally bribed congressmen. Additionally, many U.S. railroads failed to pay dividend coupons. European appetite for more U.S. rail dried up. Davies notes that the Vienna Stock Exchange peaked in March 1873. But some of Austria's large banks announced unexpectedly poor dividends. Some banks were revealed to have cooked their books. Investors pinned their hopes on the opening of the World Exhibition in May. But visitors appeared in much lower numbers than expected, and the Vienna stock market crashed hard on May 9, 1873. Brokers and speculators went broke. Half of the stocks were later delisted, per the stock exchange itself. Nicolas Barrère writes that the American financier J. Cook declared bankruptcy on September 18, 1873. Famous for having marketed billions of dollars in U.S. bonds during the Civil War, Cook had invested heavily in railroads, including the transcontinental Northern Pacific Railway. But in 1873, it was nowhere near completion, and Cook failed to raise more capital in a tight market. Several U.S. businesses had already failed that month, but the bad news on J. Cook stunned Americans. Cook's high-profile bankruptcy led to panic in Wall Street. Banks failed, credit dried up, and short-term loans were recalled. The New York Stock Exchange closed on September 20, 1873, for the first time in its history. It stayed closed for 10 days. Cook's blow-up came in the wake of drying European investment, on which U.S. rail had relied. The Vienna crash in May had dampened the mood in Europe even more. This added pressure in New York to the seasonal cash withdrawals for Midwest harvests. If you bought the top of U.S. rail stocks in 1873, you lost more than half of your money by 1877. Hannah Davies writes that Cook's failure reverberated in Europe. At first, Germans reasoned that Europe would be safe, provided no major failures occurred in London. Germans had shunned Northern Pacific bonds, but in October, rumors swirled. Several Berlin companies were in severe distress. And on October 11, 1873, the first domino fell. Quistorpsche Vereinsbank suspended payments. Other failures were then announced all over Germany. If you bought the top of Berlin stocks in 1873, you were down more than 60% by 1876. But even if you owned no stocks, and you were just a homeowner, you got screwed too. Real estate was also down 2/3 in the same period. Nicolas Barrère explains that, as German stock exchanges crashed hard, this calamity soon spread to hurt both commerce and industry. A period of deflation and economic decline followed, first in Germany, then in Europe. In 1875, the banker Baron Meyer Karl von Rothschild observed that all European economies were similarly depressed and concluded, "The whole world has become a city." This was later cited to illustrate the ostensible newness of the global reach of the Panic of 1873. The financial crisis spread throughout the economy. Particularly hit were the railroads. In a month, 55 railroads failed to meet payments. In 3 years, half of all U.S. railroads went into receivership. Rail construction stopped for the rest of the decade. This dramatically reduced the demand for many other industries. The U.S. saw its longest contraction since independence, entering a depression till the turn of the century. Our verified sources are here. Write to us in the comments section if your interpretation is different, or if you'd like to suggest other sources. What do we conclude? Before the 1929 crash claimed the name, the Great Depression referred to the aftermath of the Panic of 1873, as a full-blown economic depression spread through Europe and North America. Ripple effects reached Latin America, Asia, and Africa. The first leg of this crash, in Vienna, followed poor earnings reports. The second leg in New York followed the high-profile bankruptcy of J. Cook. The third leg, in German stock exchanges, followed a bank's bankruptcy. Because capital and trade flows were highly interconnected, a global recession or depression followed, depending on where you were. Could such an event happen again? History rhymes. What's the takeaway for you? Today's takeaway concerns contagion. Back in 1873, a financial crisis spread quickly around the world. We saw similar events again in 1929, 1974, 1997, 2008, and 2020. Will this happen again? It certainly will, as today's world is more interconnected than ever. What can you do to protect your assets? You can hope for the best, but better be prepared for the worst, always. Diversify. Have an exit plan before crisis hits, not during it. Avoid leverage. Eyes wide open, and Godspeed. Thank you for watching. If you'd like to see more financial history from verified sources, subscribe to our channel, and join our community, striving to learn from the misfortunes of others to avoid similar fates.